Welcome to our deep dive on the financing trap many homeowners fall into when funding home improvement projects. Today, we'll uncover why convenient contractor financing can saddle even top-tier borrowers with shocking rates like 9%, and more importantly, how to get out fast. To keep things practical, we'll map out a refinancing roadmap using HELOCs and home equity loans, compare the options, and give you actionable steps you can implement right away. Let's get started. Here's our agenda. First, we'll define the trap and why convenience can cost you thousands. Next, we'll explain why a 9% loan is a red flag for prime borrowers. Then, we'll compare HELOCs and home equity loans so you can choose the right tool. After that, we'll discuss why local banks and credit unions can offer better deals. Moving forward, we'll walk through a practical roadmap, followed by a timeline to execute. Finally, we'll test your knowledge with a short quiz and wrap up with key takeaways. Before we proceed, a quick disclaimer. This video is educational and does not constitute financial, legal, or tax advice. Everyone's situation is unique, so please consult a qualified professional who can evaluate your specific circumstances. Let's begin with the trap. Contractors frequently partner with lenders who promise fast and easy approvals. The process feels simple, but the trade-off is often a high interest rate, 9% or more, even for borrowers with excellent credit scores above 800. That convenience premium can drain thousands from your budget and delay other goals. Consequently, treating this as a short-term bridge and refinancing aggressively is essential. Why does 9% hurt so much? For prime borrowers, especially those with top-tier credit, a 9% secured loan is simply not competitive. On a $30,000 balance over 10 years, 9% translates to roughly $15,600 in interest, whereas a 6.5% refinance would be closer to $10,900, saving you around $4,700. Therefore, waiting passively for general market rates to fall can be risky. Instead, focus on eliminating the expensive debt now. This flowchart illustrates the journey from an easy contractor loan to a smart refinance. It starts with the contractor's pitch of convenient financing and quick approval, around 9%, which leads to high monthly payments. Then, there's a decision. Wait for market rates or refinance now. Waiting causes interest costs to keep accumulating. Refinancing branches into two options: a HELOC with variable rates and flexible draws, or a home equity loan with fixed rates and predictable amortization. Both paths culminate in paying off the 9% loan, lowering your blended borrowing cost, and rebuilding financial stability. Let's compare HELOCs and home equity loans. A HELOC is a variable rate revolving line where you pay interest only on what you draw, making it ideal for phased or future projects and often featuring lower introductory rates. In contrast, a home equity loan is a fixed-rate lump sum that delivers a predictable monthly payment schedule, which is excellent for debt consolidation when you need budget certainty. Choose based on cash flow preferences, project timing, and risk tolerance. Let's quantify the difference on a $30,000 balance over a 10-year term. At 9%, the monthly payment is roughly $380, totaling about $45,600 over the life of the loan, with approximately $15,600 in interest. At 7%, the payment drops to roughly $349, totaling about $41,832, with around $11,832 in interest. At 6.5%, you're near $341 monthly, totaling approximately $40,896, with about $10,896 in interest. That's thousands in potential savings by refinancing. Now, here's your refinancing roadmap. First, check your equity by estimating your home value and current mortgage balance to calculate your combined loan-to-value, ideally at or below 80 to 90%. Next, gather documents such as identification, pay stubs, tax forms, insurance, and mortgage statements. Then, shop 3 to 5 local credit unions and banks for HELOC or home equity loan offers. Ask about the margin over prime, rate caps, draw periods, fees, prepayment penalties, and any auto-pay discounts. After that, apply and lock with a complete file, and consider loans without prepayment penalties. Then, close and fund, making sure the payoff retires the 9% balance immediately. Subsequently, automate payments, keep an eye on variable HELOC rates, and plan early principal payments. Finally, Maintain a cash buffer, and avoid reborrowing unless the project clearly produces a positive return on investment. Let's talk about credit unions. Local underwriting can yield sharper pricing for prime borrowers, sometimes beating large national providers. In addition, you may see lower fees and more member-focused terms. You also tend to get better transparency and faster exceptions because you're dealing with real people who know your market. Therefore, aggressively shop the market and collect a minimum of 3 to 5 quotes before you decide. Quiz time. Which option is best if you want predictable monthly payments for debt consolidation? Is it A, HELOC, B, a home equity loan, C, a credit card, or D, a payday loan? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, a home equity loan. The fixed rate and predictable amortization schedule make it ideal for debt consolidation when you want stable monthly payments and budget certainty. Next, timing. Prioritize eliminating the 9% loan now rather than waiting for a perfect interest rate environment. Your goal is to lower your blended cost as soon as possible, not to time the absolute bottom. Use this 90-day timeline as a guide. In the first week, check equity and gather documents. During weeks 2 and 3, shop for 3 to 5 credit union quotes. By weeks 3 to 5, secure conditional approval and clear conditions. Then, around weeks 5 to 7, close, fund, and retire the 9% loan. Finally, through weeks 7 to 12, set autopay and make early principal payments to accelerate payoff. Here's another quick quiz. What is the primary objective if you currently hold a 9% contractor loan? Is it A, wait for market rates to drop, B, eliminate the debt quickly using a HELOC or home equity loan, C, increase the renovation budget, or D, ignore credit unions and use the same lender? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Eliminating the 9% debt quickly using a HELOC or a home equity loan is the priority. Treat it like a financial emergency and focus on bringing down your borrowing costs immediately. To keep you on track, here's a quick checklist. First, confirm that your combined loan-to-value ratio is at or below 80 to 90%. Next, gather pay stubs, tax forms, insurance, and mortgage statements. Then, obtain 3 to 5 credit union quotes. Afterward, compare the margin over prime, rate caps, fees, and any prepayment terms. Then, schedule the payoff of the 9% loan as part of closing. Finally, set up autopay and plan extra principal payments. Let's crystallize the key takeaways. First, 9% for prime credit is a red flag and should trigger immediate refinancings. Second, choose between a HELOC for flexibility or a home equity loan for predictability. Third, local credit unions often beat big providers, so shop aggressively. Fourth, focus on lowering your blended costs now rather than waiting for perfect timing. Finally, automate payments and make periodic principal prepayments to accelerate savings. To wrap up, identify the financing trap and refuse to pay a convenience premium. Map your refinance using a HELOC or a home equity loan, shop locally, and close quickly. Execute the 90-day plan and rebuild your safety buffer. With your top-tier credit, you deserve competitive terms. Go claim them. Thanks for watching. If this helped you, please like the video, share it with someone facing high-cost financing, and subscribe for more playbooks. Tell us in the comments which option you're pursuing, HELOC or home equity loan, and what rates you're seeing from local credit unions.